So it's a horrible thing to say, but I mean, if I was a guy at the same position, people would not be like, wow, you're so accomplished. It would just be expected. So you can look at it from a flip side. Do we have lower expectations of women versus men or whatever? I'm a feminist and I'm not a feminist in that sense. Is that I think a lot of women choose to get out of the market. I've not found it. I mean, I wish I could play the woman card, but it would be unfair.
Got it. When should you be raising money from venture debt funds? What are the pros and cons? How do venture debt funds evaluate companies and how is it different from a daily VC or equity funds? Today, we are talking to Tarana Lalwani, a partner at India's largest venture debt fund, Innoven. Now, she has seen India's startup ecosystem since its early days and has been amongst the very few women to have had that privilege, right? In this episode, we discuss money and the color of money and the people behind it. Don't miss, watch till the end. But one last bit, it would mean a lot to me if you subscribe to Go Venture channel at this point. Hey Tarana, welcome to the podcast.
Thank you. Look forward.
So Tarana, to start with, you've worked with multiple or have led multiple funds or say investment bodies in the past, like Innoven, Mumbai Angels, Seedfund. But people say money has no color, right? But also people say founders should be careful about who they raise capital from. What do you have to say about it?
Okay, so I'm going to start off by correcting you. I didn't lead. I was part of Mumbai Angels and part of Seedfund. I didn't start them, so it would be unfair to take credit for that. And at Innoven, I came in, and then now, of course, we're a fund and a partner there. So that correction. And to money, I mean, I think it's important who you take money from, right? Yes, the color of money is the same. It's not fungible. But there is after all, when you're working with someone and you take money from them, there is an individual with it as well. And that individual is not colored, right? I mean, the color of the money then is not the same. Every individual is different. Mm-hmm. So I think having chemistry with the individual you're working with, especially when it's equity money, it's a long term. It's like a marriage, right? Your partners. Mm-hmm. The founder is someone who's putting in the effort and the operations, and the investor is bringing in capital. And both are adding value in their own way and complementing each other. Without one, the other would not work. So I think you have to look at it from a long-term relationship perspective, and there it matters, right? Who you get the money from, do they share your vision? I mean, this is from a founder perspective, but even on both sides, right? Can they, agree to disagree? Do they complement each other, yet they can work together? Do they share the same set of values? Like any relationship, right? Friendship, any sort of equation you have with an individual, it matters that you're able to get along and work together. So I think from that perspective, who you take your money from matters.
Okay. And what do you think? What do you think are some key stuff that founders should be looking out to? Red flags that founders should be looking out to?
I mean, I don't think there are any red flags. As a founder, if you're taking money, I mean, you have to also sit and figure out what money you need, how much you need, who you need from, right? But if you start off as a founder and you get someone, I on both sides as a red flag, right? If you get a investor who's too eager and never questions you should be concerned. On the flip side, if an investor is you start off on the wrong foot, there's a concern, right? Because then you're just starting off at a place of animosity versus, that, okay, let's work together. But I think the one red flag I'd say is both founders or investors should look at it that when they go into this, it's a win-win for both. One shouldn't feel that, the founder shouldn't feel he got drafted by the investor and vice versa. That, they lowball me on valuation or terms and, same on the other side. So I think that would be the one sort of starting of red flag. Everything else, so you only find out as you work together.
Got it. And so you have been part of funding journey for a lot of startups in the past. I want to talk about, say, the most innovative or the most memorable startup that you have invested in.
Well, I think the most innovative, I don't know, but I think there have been a couple of startups that, again, now what do you define what was memorable about it, right? Was it that it was your first deal you did? That's why it's memorable, or is it memorable because of the people you're working with? who you interacted with. So for me personally, I think the most, at that point, a very innovative startup was when I was at Seedfund, was a company called Vunik. We worked with the founder, Sujayat Ali, and, at one point it was like one of the most downloaded, chased startups in the ecosystem. Now, for me, it's memorable because it was one of my first deals at Innoven at Seed Fund that I led. And it was interesting because I literally educated the founder on the term sheet, because this was his first term sheet to drag, tag, write, slick pref, everything, right? So it was sort of like a partnership where I felt like I was truly working with someone, starting something with them. So it was memorable from that perspective. Then obviously he did well, but also it was a learning for me to recognize, and this was a joke, that recognizing that a person's personality matters a lot in how you work and where you work with them, or the experience, because he was one of those really solid, grounded founders, and I respect that, because when he was on a high, things were going great. Also, he was the same individual, and that was a learning, right? You don't change. He didn't change because suddenly he was successful. He didn't change when things were rough. He didn't change. He was just a decent human being. And so for me, I think that's why it holds a little bit of significance, that I learned. It was a learning for me, negotiating a term sheet and making it a win-win on both sides, explaining to someone what the terms meant and then making it work. And then, just seeing how this sort of whole relationship played out. On the
And
flip side, I
Tarana,
also have other great.
yeah, please go ahead.
Go ahead. Yeah, no, I was saying on the flip side, also I've had some great founders that I've even worked with at Innoven, and that's what makes it, for me, the people work with makes it memorable, and sort of more than, I would say, innovation, right? I mean, I have a company called Elastic Run or Porter that I worked with in the early days when I joined Innoven, and I think that my interaction with those founders is so that I enjoy it, and so I would call it memorable. You want to be able to have a good experience with anyone.
And so far, how many deals have you been part of, Tarana?
Oh my God. Now I think in the last, between Seed Fund and Innoven, I don't know, 40, 50 deals.
And
I
what
can't
what
even keep
would
track, because I'll tell you why it's tricky on the debt side, because on the debt side we do a lot. So on the debt side we do repeat deals in companies. On the equity side you'll do 3 or 4 deals a year. On the debt side you'll do 10, 20 deals a year, 15, 20 deals. Sometimes a lot of repeats. So, but I'd say easily 30, 40
okay?
deals,
And that
if
that
not
brings
more.
me to that brings me to probably a question that a lot of founders have, which is how does say venture debt work, and how is it different from a normal NBFC or a bank debt in general?
Okay, so quickly now, the easy one is the venture debt is different in the sense that it's not a bridge loan. I want to clarify that, and not that people assume, but it's not a bridge loan or bridge capital. It is basically, in some ways, to look at it as a top up to your equity round. Now it's called venture for two reasons, at least that's my rationale. One, that we come into companies that are considered venture, right? New economy businesses generally. And two, that we like to see a venture equity partner in there, an institutional investor in there. So hence the name venture. Now it's a top up sort of, now these companies unfortunately are loss making companies. They don't necessarily have hard assets. So they can't raise traditional bank debt, which is where we play a role. So, a lot of these companies, like, may have maybe a brick and mortar business where they need working capital or capex. Now, banks will not give them that. So that's where we play a role and come in. On the flip side, there could be companies that want to accelerate growth, or want to raise a little more capital, but they don't necessarily like the valuation they're getting in the market. So they say, okay, instead of raising 5 million in equity, I'll raise 4 in equity, 1 in debt. Vice versa, you've got interest for 4, but you believe you need 5 in this environment. You want a little extra money, you raise it in debt. So I always say it's like a top up to your equity round. It's not a bridge loan, and we come in usually as close to the equity round. But if I had to simplify it, I'd say we come into companies where we see at least they have 12 months runway, they have an institutional equity investor, and ultimately, Pritesh, it is debt. It is not equity. I cannot afford for it to go to zero, and for the founder, he does have to repay this. So that's something to keep in mind. How we're different from a bank. So, in terms of NBFC, in fact, interestingly, we were an NBFC and moved to a fund structure. So the vehicle doesn't really matter from an NBFC perspective. What most traditional NBFCs are not able to get there because they don't understand this asset class. So I don't think it's now where banks are concerned, we're different in the sense, one, our money can be used. As I said, we don't take any hard assets as collateral generally. I mean, these companies don't have it, and banks have a different risk appetite. So that's the main difference. But a couple of things, our money can be used for acquisitions. Our loans are generally purpose loans, which can be used for anything. I'm not like a bank looking at some sort of drawdown schedule, working capital line, hard assets to give the money. And we also give you a lot of flexibility in the sense, now tomorrow, these are startups, right? These are early stage companies. They're constantly evolving. We don't put stringent covenants. Tomorrow something comes up in the business, they have to tweak something. We're flexible. You come and talk to me as a founder, and we'll figure it out together. With banks, I'm not saying that banks won't do it, but it's a little more complicated. They have a huge structure. Who are you going to speak to? It's pretty hierarchical. So then where do you get to? Who do you talk to? So I say broadly, the venture debt model gives you more flexibility as a founder relative to a bank loan. That's the primary difference. We are more, because we understand that these companies are constantly pivoting, evolving, different use cases, and that's where we can sort of partner.
Got it. But you said that mostly venture debt, what happens is that is raised very close to the equity round, and it also serves as a
Yeah.
top up, right? But like when founders are raising, most of the founders have a certain runway in mind that they're raising for, certain growth in
Yes.
mind that they're raising for, right?
Yeah.
So if it's a debt and it has to be paid off, like how does it look like
That
how
work.
come it still
So,
looks like a top up?
so I'll tell you, there's two reasons why we come close to the equity round or want to see a certain runway in the business. Like any business, old economy businesses, new economy businesses, if you can't service your debt, it can accelerate the death of the company. I mean, cash is king, 101 of finance when you go to business school, right? Now, we come into companies where we see the runway. It's twofold. One, as a debt provider, I want some security. What is my security? That this company will continue being operational. The longer they stay in operations, the better chances they have of raising the next round of equity. So if they have 12 months runway, I say give them a loan for 2 years. Part of my loan has been paid out through the first year, after some moratorium period. The balance will get paid out if I believe this company can raise its next round of equity. Right. And so the longer they are able to stay around, the longer better their chances of raising equity. Now, on the flip side, if I come in as a bridge where the company has 3 months runway, it's unfair to the company, it's unfair to me. I may risk losing my money, but for the founder, unnecessarily has this burden on his head to service this debt, which he may not be able to. And it just creates a little bit of, stress for him, investors, everyone. So, which is why we try and come into companies where there's visibility of nine. We can always figure that out, but the broad back of the envelope is 9 months and beyond runway, where we know, because usually it takes anywhere from 3 to 6 months to raise a round, right? So you want
Yes,
that peace
yes.
of mind. You don't want to be stressing about it.
And I want to talk a little bit about the other side of venture debt, which is when you're raising from your LPs,
Sure.
right? Say,
Yeah.
how does it look different when you're raising from your LPs from a traditional equity fund, let's say, when they are raising from their LPs?
So we are a more hybrid product, right? Where we are giving more predictable returns to our LPs. So in the venture debt model, what we promise our investors is a return of between 16 to 18% IRR over the life of the fund. Now, how do we return their money? We give them quarterly interest payments on the money that they have invested with us, followed by after year 4. So we recycle this capital principal for, you know, 1.5, 2 cycles, depending on the tenor. And then after year 4, we start giving back principal, as well as, if in our venture debt model, we also take warrants. So on the loan, we usually take a 10% warrant coverage, which is an equity kicker. So if I give you a loan of $1 million, I'll say I have the right to buy shares worth $100,000, simply like ESOPs at the current valuation. So that upside. With that upside and the yield on the interest income yield, we're able to return 16 to 18%. So our cash flows are more sort of predictable, and sort of, you can say, in some ways, not, I wouldn't say the word is front loaded, but it's not back ended. Whereas in an equity fund, the money LPs receive is more back end, right? After the investment cycle, and then as capital gains and returns happen, that's when they can expect their money back. So that's sort of a difference. So it's more about predictability and getting cash flows overall. But of course, in an equity fund, you could tomorrow get 10x your money. In a debt fund, unlikely that will happen. Maybe at the most, if you're lucky, you'll get 2x, 3x.
So it's mostly predictable and continuous, you're saying, right?
Yes, yes.
So let's say, what would you say as an LP? Should they be investing in a venture debt fund or an equity fund?
I think a mix of both, right? It depends on your risk appetite. I mean, jokes aside, it depends on your risk appetite, what you're comfortable with, what you're looking for, right? With us, generally the downside is also very limited. We'll never go to zero. Very unlikely we'll go to zero. And so it depends on what your cash, sort of your horizon is, your risk appetite is. If are you looking for predictable cash flows? If you have a very large corpus, I'd say, like all of us, right? You should diversify between fixed income, hybrid, and equity funds. So I'd say broadly, any LP should do that.
Got it, got it. And when do you think, like, I want to go a little deeper. I noticed that you
Sure,
mentioned
of
like a
course.
little bit of that. But when do you think a startup should consider venture debt as part of their funding strategy?
So ideally, they should consider venture debt after they've done product market fit and have some revenue generation. So Series A and beyond. And venture debt technically should play a role between Series A to Series CD when the companies do not qualify for traditional debt, are still high burn businesses or burning cash businesses, loss making, blah. However, in the market environment that we were in a few years, for the last couple of years, we were exceptionally doing some pre-Series A companies. And we have also done some late stage companies, Series D and beyond, just because, some of them wanted acquisition financing, or they just weren't able to get traditional bank debt, or they're basically they haven't qualified for it. So we sort of ended up playing in the whole magnet, but overall you wanted to sort of be Series A and beyond to Series CD ideally. But having said that, we've done exceptionally Series A, and we've gone beyond Series D and E in certain companies just because of their requirements.
So what's your like Innoven is probably India's largest venture debt fund. What's the kind of mandate that you have? What's the kind of ticket sizes that you put in?
So I always joke that we're definitely sector agnostic, but we're also stage and check agnostic. So we do checks as little as 500,000, as high as 15 million. So it's broad because the whole intent with venture debt, so unlike an equity fund or most equity funds where they have different stages, right? They'll participate early stage funds, growth stage funds, late stage funds, or, our intent when we come into a pre-series A or series A companies, that's starting the relationship. As the company grows, we will do more in them. So there are companies we've given loans 7 and 8 to, literally facility 8, facility 7. As they've grown, our check size has grown with them, and we've given them more. And that's the intent, that we can continue working with you.
Got it. And how large is the fund at, say, Innoven?
We are a $200 million AIF fund approximately, yeah.
Got it, got it. And how do you evaluate companies for venture debt at Innoven?
So you wear two hats. You wear a debt hat and you wear an equity hat. So like I started off saying, right, I runway. So from a debt perspective, because I don't do the extensive due diligence that equity guys do, I look at the cap table. I look at, do they have any institutional equity investors in there from a governance point of view, from a DD point of view. I look at the runway, and I follow the cash very closely. So we look at, I always joke that for me it was a learning. So my undergrad was an accounting degree. Do I remember anything of my accounting? Zero. I never used it in my life until I came to Innoven to some extent, because once I was in the venture ecosystem, all we did was look at P&L burn, even at seed fund or whatever, because as equity investors, we end up focusing a lot on that and forget that there's something called a balance sheet burn or a working capital burn, or, you forget those things. So it was actually a learning when I came back to debt and saw that, okay, so we follow the cash closely, looking at all burns, working capital, P&L, and capex, and then figuring out what the company's real runway is. So the runway, the investors. So that's primarily following the cash and looking at it. Can this company service the debt? Do they have the ability to service this debt? How will they sort of grow the business? And where are they spending this money? Discretionary, non-discretionary, balance sheet, P&L, sort of on what? Then because my money is based, or my rather return will be based on the ability of this company to raise its next round of equity and continue to repay me, that's where I wear the equity hat. Okay, so there I'm sort of similar to an equity investor, quality of founder, market lead, are they market leaders, which is also similar on the debt side. Obviously I'll see all this as well, but more focus on that for the next round of funding. Ability of founders, quality of founders, TAM, who will come in, what is the potential, are they market leaders, crowded space, sort of all those things. So not that you don't look at those on the debt, but sort of then the weight on that goes higher. So we look at both aspects of the business and then underwrite it and then decide, okay, what are we comfortable doing?
Got it, got it.
And generally, sorry, I'm going to take a step back and prompt on something. Generally, venture debt, back of the envelope is anywhere from 20 to 25% of money in the bank. Now, that said, we could sometimes do even, 1:1 of what money is in the bank, but that again will come down to what is the use case of the money, what are they using the funds for, how long is their runway, etc. as well.
So you mentioned sometimes you have done 1:1 kind of money. Those kind of deals also. Like, are there any specific instances where? Are there any specific instances?
Yeah, we've done those in a few specific things in a lot of lending businesses, the Thassio models over there where debt makes sense for the business to sort of grow. It's, you can call it a semi, like we joke, a raw material. So exceptionally, yes, sort of.
So are there, so this might be confidential, so feel free to tell me, but are there any deals where you took a massive leap of faith and that failed? Any specific instances there?
Touch wood so far, and I'm not touch wood so far. No. We have had stress. We will have stress in this environment, but so far, no leap of faith that has resulted in mortality. So far, who knows?
And that's a
fingers crossed.
That's a crazy statement given the fact that probably you guys are the leading and the largest debt fund.
We do have the largest portfolio. I'll tell you. So I'm again looking at this portfolio. So let me take a step back and tell you why that has happened partly. Have we had losses? Yes. Have we had NPAs? Yes. But they have never been whereby if I gave a company 100, I lost all 100, right? Because partly they've always paid me something back. So I've always, if I give someone say $100 over 2 years, let's assume for simplicity, there was no moratorium. 50 of it came back in the first year when they still had a runway, right? So then the balance 50 plus something could have gone. And also I'm looking at the portfolio from the time I came on board, which is 2017.
Got it.
So, but as an asset class in India, I don't think this asset class, or at least at Innoven, where we've had capital erosion, we've always returned capital plus. We haven't had that yet.
Got it. That is crazy. That is crazy, I believe.
Yeah, but but we have, as I said, we've had NPAs, we've had all that, but we've never, so far we haven't lost money where it's like my DPI is, 50 to the 100 or whatever. We've always returned plus, and we've also seen, at the last few years prior to 21, our returns to our investors were in the low 20s. But that was just a stroke of luck as well, along with us being a little more smart on the realizations of capital gains.
Got it. Awesome. Then I want to come back to your journey. I think you have had a crazy journey, I believe.
Actually, can I, interrupt you for 1 second? Yeah. So, but in this asset class, losses of 2% are expected as a norm. But so far, it hasn't happened. It could happen in this environment. We don't know yet.
I would say those are way low.
So I don't want to say it's,
Those are
then you would expect, yes.
Yeah. And in fact, the NPA numbers of probably most of the banks today in India are higher than 2%, I would say. So,
as you know, this asset class, actually, I'm not going to say it's like giving you a fixed, the risk return is super justified, but touch wood, so far, we've had a good environment. And we've also, I think, hopefully as a team, yeah, hopefully as a team, we've also done a good job, right? I'd like to believe that.
That's crazy, Tarana. I was just thinking about it, but if you think uh, probably venture debts in India are taking the most risky debt calls, at least debt deals, at least, right? While on the other hand,
Yeah,
probably the banks today or the NBFCs today are taking so-called safe bets,
safer.
right? Safer
Yeah.
bets, yeah. And still, the banks today end up having a higher NPA. Probably then definitely probably higher than 2%. What's going
Yeah.
wrong? What's the difference? Do you think there?
I think we've also been in a very conducive environment for the last few years, right? So let's not
Hmm.
take away that the environments have been conducive. A lot of capital has come into the market.
Hmm.
So that has worked to some extent. And partly, as I said, the way the venture debt model works is we're pretty in our I mean, I'm going to say we're the best at our underwriting, but we're all relatively sort of thorough in our underwriting where we're able to sort of plan for, as I said, it's not a bullet payment loan. It's a monthly amortizing loan. So we're able to manage it. And as you can, and as a portfolio, you're getting 10% of your money back. Let's assume for simple math every year, because I mean it's more than 10, but assume 10% interest comes back. So right there by year 4, as an LP, you've got 40% of your money back in the form of interest. Then you start getting principal repayments. Then you may have some deals like equity that will give you those pretty strong capital gains on the warrants that we exercise. So all that then helps you sort of get to that 16 to 18%. Listen, even with it, I mean, it's still 16 to 18. It's not 35% IRRs, right, on the portfolio.
It is crazy. I think
So
I was
that's
looking up the NPA numbers. The NPA numbers for Indian public sector banks, at least, we are close to around 14.5% around 2018, and are still at around 5.5% in 2022, December 2022, versus the NPA numbers of 2% at a startup venture debt kind of ecosystem.
well, I think you have to understand banks do a lot of different products as well, right? Let's leave it at that. And
Wow.
sometimes there
Yeah.
is a little bit of a yeah, I mean, I can't comment on banks. We know banks work differently, right,
Yep.
to
Yep. Yep.
us. Their product offering is a lot wider. They do a lot of, there's a lot more that goes into a bank's underwriting relationships that, you
There is
know
a, I believe there is
and
a lot less, there is a lot more professionalism in the startup ecosystem versus, say, a large bank or something like that. And where a lot of
I'm
other
very tempted
aspects
to say
also
a
come
lot
into
of
place.
things, yes, but I think we're both sort of insinuating the same thing that may be happening at banks that doesn't happen at a venture debt fund or within the ecosystem, we hope.
Yeah. Yep, yep. I want to come back to your journey, Tarana. And
Sure.
like I said, you were probably among the only few women, say, a few years back when you started up in the early days of the startup ecosystem in India, right?
Yeah.
How has it worked for you in your favor, or has it been tough? Can you share maybe a few instances?
Sure. So honestly, I mean, I moved back in early 2000, late 2006, early 2007 with a startup. And then I moved to Seed Fund. So at Seed Fund, interestingly, we were 3 women in a team of 8 investment professionals. So it wasn't so, I mean, pretty decent
Was
percentage if you look at it as a percentage.
was it a conscious effort, or was it like just
No, no, no. I don't
instinct?
think it was conscious. And same thing at Innoven. When I first joined Innoven in 17, we had a lot more women in the team. And most of them left, but not for any other reason other than, a whole bunch of them actually went to business school or moved to the equity side, not for, again, for. So I personally have never felt, I've never felt at a disadvantage. If I have to be honest, and a lot of women hearing this may not like this, I actually think being a woman has worked in my favor uh, on two grounds. One, I think it gives you recall value, right? Because there are less women. And two, this is a horrible thing to say, but I mean, if I was a guy at the same position, people would not be like, "Wow, you're so accomplished." It would just be expected. So you can look at it from a flip side. Do we have lower expectations of women versus men or whatever? But so I personally don't think. I think, my personal take always, and I'm a feminist and I'm not a feminist in that sense, is that I think a lot of women choose to get out of the market. It's not, and I'm going to get a lot of, you'll probably get a lot of backlash for this, but and then we go around cribbing about it. But the fact is, I think if you do your work, you'll be fine. And again, that's it. From a disadvantage perspective, I think initially when you get into the market or are building, it's hard on both sides in a different way, right? Or it's just different when you interact, or hard to interact with someone of the opposite gender, because when you first get it, and it's building that sort of comfort and equation. If I meet someone, a VC partner, and I have to think twice, and so does he, both ways, that hey, should he say, hey Tarana, let's go grab drinks or dinner, right? Because it could be misconstrued. And it works both ways. Like I said, it could be the same for him or me. But once you sort of have spent enough time in the ecosystem and people know you and you know them, then you can have that same equation that two people of the same sex gender would have. So I have not found it. I mean, I wish I could play the woman card, but it would be unfair.
Got it, got it. And
I
like,
don't
what
know if that's
about
what you
what do you
wanted to
think?
hear, but
And what do you think? What do you think happened with the other people that probably got started, other women that got started with you during the same time?
they're all doing well. I haven't met anyone who, I mean, maybe some have decided to leave the ecosystem, but I think most people are still around. Paula Mariwala, who was with me at Seedfund, runs her own single family office. I mean, of course, you have people like Vani, who are very known in the ecosystem. And then, I think a lot more people came after. So, I mean, and they're all doing very well, right? I mean, there's Sakshi at Sequoia, there's I'm trying to think. There's Kanika at Vertex. So, they came in a little later. They're slightly younger, and everyone's doing well. I don't think anyone would say that it's been a tough challenge. I don't know. I don't know their journey, so it would be unfair for me to comment. But personally, I
Got
can't say that I can play that card and said I went through. I was lucky. I was lucky.
But I also want to talk about this one bit that you came back to India after 14 years in the US and suddenly got involved in the startup ecosystem, which was not something that you were doing earlier, right? How did that happen
Yeah.
and why?
So I was in the US doing hardcore finance. I mean, I worked at Morgan Stanley, then I went to Columbia, then I was doing ABS, MBS. If you ask me anything, I don't remember anything of what I did at Radian. It was by fluke. I wanted to move back to India. I kind of had reached a point where I was like, okay, if I don't move now, I'm not moving. And I was very keen to move back home for personal reasons. And I had seen the dot-com bubble in the US, and I'll be honest, my initial thoughts were I want to come back in a finance role to India, but then I happened to meet the founder of Webberoo, and he sort of made me an offer, and I was like, okay, in some ways I've seen the dot-com bubble. Who knows? This is my chance. I mean, it was partly greed, partly keenness to come back to India. That hey, I could make millions of dollars being part of an early company at a point, and so that's how I stumbled into venture, and
And
that's
this was
how
the
I
company
came
that
back to do biz dev
eventually,
very early.
th- this was the company that eventually became Gupshup, right?
Yes, SMS Cup Shop, yeah.
Yes. Got it.
And so I came back and joined them, spent a year, very early days. And at that point, I was like, I'm still going back to finance, because then, we'd meet investors, different quality of discussion to when I went to, and I was not a techie, right? Meet OEM manufacturers. I was like, okay, I'm not a techie. I can't do venture. I don't, so I was pretty set on actually going back to finance. But then global financial crisis hit. A friend of mine was starting an education venture. So I started helping him sort of landscape the whole education market. Parallelly got involved with Mumbai Angels, um, and started looking at early stage investment. So it was coincidence, fluke, whatever, random, serendipity.
Got it. Got it. And
So
how do you
that's how
think,
I got into venture. I
and how
love
do you
it. I
think,
mean, if I'm in this ecosystem, it's because huh.
yeah, please go.
Sorry, Pritesh. Yeah. I said I love it. I mean, I honestly, once I started getting involved, meeting interesting founders, learning about their journeys, learning about different models, I think I just started enjoying the quality of conversation and people I was meeting. And so if I'm here, it's because of that. If I had a great idea, I'd do a startup myself, but I don't. So I figure I'll just piggyback of the founders I meet and share in their success.
I think Tarana has been almost, I believe, 16, 17 years now that you have been part of the Indian startup ecosystem, which is a long time. The Indian startup ecosystem
Yeah.
is pretty young for someone to have been involved in it for 16, 17 years. And how do you think you have been able to, and you are now able to, given that your partner now at Innoven, how do you think you are able to support the growth and success of the organizations?
I'd like to believe that you've that I've built a network where, and it's also, you have to just have a mindset that you will play it forward, right? So I think one side is okay, being able to be a capital provider, but I think more important is to be willing to work with the ecosystem and the founders and folks to sort of value add wherever you can. It could be like someone's looking to raise money and connecting them to other equity fund investors, vice versa. If equity funds are looking at it for interesting deals, connect them. Someone's looking to get hired. If you can, we have an active portfolio of 60 companies. If they can, we can connect folks within our portfolio companies, but even outside to, other companies that could use them, sort of. I think it's just about having that attitude that, let's play it forward and build a network where we can all work together, a collaborative environment.
Got it.
I think it's
So that's a lot of
important. So
that's a, that's a
I'm a
lot of
jack of all
networking.
trades, so I don't have anything to add. Huh.
There's a lot of networking going on, I
Yeah.
believe, there that say funds are able to facilitate. And probably I've been on the other side of it. I can see definitely that that's a major advantage for uh, startups and founders to be able to relate to those kind of funds and those kind of partners. But yeah, apart from networking and the capital, do you think there is any other scope that for funds and partners and say investors to be able to participate in the startup ecosystem?
Of course, I mean, if you've had operational experience, just what you can bring from what you see, right? I mean, we've all seen, like, you learn. I mean, like, when you're involved with companies, you're able to, the knowledge that you build at one, able to sort of use it at another one, right? I mean, that's like a given. If you're not applying what you sort of pick up and through your different experiences, then
Do
yeah,
you
then
have
you're not,
any
then you have
examples
no
here?
value
Maybe
to add.
you want to share any anecdotes here?
I mean, just, like, if you're looking at a whole bunch of D2C businesses, like, you learn about distribution, you learn about what the margin should be like, how they sort of expanded. And then hopefully you can apply that to one of your other, when you're talking to other D2C companies, or vice versa, same on the logistics side. How can they sort of do certain things, or brand building, right? So those sort of,
Got it.
or
Got
even
it.
just
Got it.
from a, human capital perspective, right? How someone managed something at a firm, and how can they sort of, the takeaways from that, and then sort of bring that to another of your portfolio companies.
So I think you mentioned D2C, Tarana. I want to interesting that you mentioned D2C, and D2C is probably emerging and being seen as the next wave of e-commerce. I want to understand how investors look at D2C, how that whole ecosystem is being, and also D2C is being massively popularized by the Shark Tank, whole the Shark Tank phenomena that is happening
So I
in the
can't speak
ecosystem.
from the shark. Huh. I can't speak from the Shark Tank perspective because I don't watch the show. I should, uh, but I think I don't think that, I think D2C right now, there is a lot happening in D2C. Um, but that said, I think I wouldn't say that it's necessarily like what was a few years ago with the fintech or a few other things that were sort of, it's gained momentum, but I think it's somewhere also at that crossroad where we'll figure out where it goes. I think I'm not going to, I, I I think I'm going to differ with you on that. That it's necessarily like we're seeing a lot. There is a lot. What's going to happen is another question, in my opinion, because I mean, D2C performance marketing is getting expensive. So now, are these D2C brands going to go offline again? So are we going to see? And we're seeing that, right? We're seeing now a lot of companies are looking from online to offline. So I think we're in to figure out what, I think there'll be a lot of, actually, personally, I think there'll be a lot of consolidation in D2C.
I think what you mentioned is that I can see that Nike has opened stores, First Cry has opened stores. All of these companies have
Yeah.
now opened stores
Or
all around.
offline.
But
Because
also,
at some point you have to get that. Yeah. So I think we'll actually see some consolidation plays.
got it.
Personally. I could be wrong, but
But also, I think what has happened is in the D2C is that a lot of these companies have started a new wave of customer or new, I think, technique for customer acquisition, which is very Instagram heavy, very social
yeah,
media
yeah.
heavy, and all of that, right? Very organic in that nature, right? They're not very focused on maybe
Organic.
SEO. They're not very focused on maybe getting themselves on the Google pages. They're more focused on getting themselves in
Yeah.
front of their audience on Instagram, right?
Exactly. True. But that also is still early days, and also that, I mean, that is getting expensive as
Yep,
well.
yep, yep.
I mean, wherever we all gravitate, demand exceeds supply, and then of course the demand supply mismatch happens. No.
Yep. So, Tarana, one last bit that I want to understand. Say, you've
Sure.
been part of multiple funds now and that now engage with startups in multiple ways also, right? But innovation in startups is a very rapidly evolving field, right? How does someone at a fund stay updated in so many domains at the same time since you are continuously evaluating multiple startups in totally different domains? Yeah.
Oh my God, it's not easy. It's tough. It's a learning. And I'm not very good at it, if I have to be candidly honest. I try to listen to as many podcasts, try and do some reading, but I think I have ADD, so it's very hard to read these days. So I think it's podcasts, trying to meet people who can add value and sort of educate you. I think that's the best way to sort of, because then you get real time sort of real life examples and story experiences, and also you can ask questions. So I personally think that's the best way to sort of educate yourself these days. I've tried the courses and all, but hasn't worked for me. But that's something one can do as well. So I think one of the things that we don't use, and I'm realizing more and more at least, is used a lot by a lot of PE funds actually, and not us, PE and VC funds, is they use sort of experts, right, to sort of get on a call with an expert and educate themselves. And I think that's sort of a good way to sort of get up to speed.
I think, Tarana,
And podcasts like yours, yeah.
you mentioned talking to people. I'm not sure if I should be saying this, but yeah, I think what happens is that as a founder, when I have had so many discussions with the VC, I've seen so many founders do these discussions with funds and capital and VCs and all that. What happens in those discussions is that you try to play down your play your strengths and play down your weaknesses, right? So I think it's very difficult to actually from what I have seen is to actually understand the business from those pitches, right, or from those discussions, right? Because there is a very
Oh,
different
oh no. I'm saying
dynamics in that conversation.
yeah, those pictures are very different. But I also think there's no question that's dumb. Personally, I mean, no point. Just ask. But this is more I'm saying informally, right? You and I catch up, and I ask you to explain to me something that you know about crypto or Web3 or climate change or whatever, right? So it's not necessarily that I'm meeting you and you're pitching to me. You just catch up with someone and learn from them. We all have
Got it.
something. I mean, every individual has something that you can learn and offer, and so it's a
So
give and take.
let's say our audience wants to reach out to you. What
What
would be the best platform to reach out to you? LinkedIn,
I think best
Twitter.
way to reach out to me is LinkedIn, or I mean, even not LinkedIn or Twitter is fine, but also my email ID, tarana@innovencapital.com. So I think that would be
I'll
a
put
good
it
way.
in description notes then. Okay.
Sure, please do. Yeah.
If you enjoyed this, it would mean a lot to me if you subscribe and share your thoughts, reviews, and the guests you want. दोबारा मिलते हैं next discussion में.